Common Stocks and Uncommon Profits by Philip Fisher feels less like a textbook and more like sitting down with a wise, seasoned mentor who wants to guide you through the intricate world of investing. Fisher's approach is not about charts, numbers, or short-term predictions, it's about understanding businesses deeply, thinking critically, and investing with a long-term perspective. Through his famous scuttlebutt method and his emphasis on qualitative analysis, Fisher gives you a toolkit to become a smarter, more thoughtful investor. Think like a business partner, not a stock trader. Fisher begins with a paradigm shift: investing isn't about flipping stocks for quick profits. Instead, it's about becoming a partner in a business. When you buy a stock, you're buying into a company's future. So, before you invest, ask yourself, do I understand this company well enough to own it for the next decade or more? Fisher encourages you to dig beyond financial statements. Instead of relying solely on numbers, immerse yourself in the company's world. Speak to customers, suppliers, employees, and competitors, what he calls the scuttlebutt method. By gathering first-hand insights, you can uncover the true strengths and weaknesses of a business. What makes a company great? Fisher outlines 15 key criteria to identify a great investment. These aren't checkboxes but rather a mindset, a way of thinking about companies and their potential. He focuses on factors like innovative leadership: is the company constantly pushing boundaries, creating new products, or improving existing ones? Market position: does the business dominate its industry? Is it the go-to name for customers? Growth potential: can the company expand its market or enter new ones? Management integrity: are the leaders trustworthy, transparent, and committed to long-term success? Customer loyalty: does the company have a loyal customer base that keeps coming back? By asking these questions, you start to see companies not as symbols on a ticker but as dynamic, living organisms. You're looking for businesses that can grow and adapt over time. The power of long-term thinking. Fisher emphasizes holding on to great companies for the long haul. Once you found a business with strong fundamentals and growth potential, patience is your greatest asset. He warns against the temptation to sell too early, even when a stock has risen significantly. If the company's story hasn't changed, he says, why should you sell? Imagine buying shares of a groundbreaking tech company in its infancy. Over the years, it becomes a leader in its field, expanding its product line, increasing revenues, and strengthening its market position. Selling after the first price surge means missing out on decades of compounded growth. Mistakes are inevitable, learn from them. Fisher doesn't shy away from discussing mistakes, both his own and those of others. One of his most memorable lessons is that the fear of losing money often holds investors back from making bold decisions. But mistakes, he argues, are part of the learning process. When you make a bad investment, instead of beating yourself up, dissect the decision. Was it a lack of research? Overconfidence? By analyzing your errors, you become a better, more resilient investor. Avoid mediocrity. One of Fisher's most actionable pieces of advice is to avoid mediocre companies, no matter how cheap their stocks seem. A low price tag doesn't make a bad business a good investment. It's like buying a rusty old car because it's cheap, you'll end up spending more on repairs and maintenance than it's worth. Instead, focus on high-quality companies, even if their stocks are expensive. Over time, the performance of great businesses far outweighs any short-term savings from buying undervalued but subpar companies. The human element in investing. While many investing books focus on numbers and models, Fisher places a strong emphasis on people. He teaches you to evaluate the character and competence of a company's management. Are they genuinely passionate about the business, or are they just chasing profits? Do they prioritize shareholder value, or are they enriching themselves at your expense? Fisher's approach feels personal. He's not just talking about companies, he's talking about the people behind them. And by understanding their motivations, you can make more informed investment decisions. The art of selling, or not selling. Selling, Fisher admits, is one of the hardest parts of investing. His advice? Only sell for two reasons. The company's fundamentals deteriorate, if the business loses its competitive edge, management falters, or growth stalls, it's time to reevaluate. You find a better opportunity. If you discover a company with stronger prospects and limited funds to invest, it might make sense to shift your capital. Otherwise, resist the urge to sell based on market noise. Holding on to a great company, even through temporary dips, is often the best course of action. Investing is personal. Fisher's writing feels like a conversation, a reminder that investing is as much about you as it is about the markets. He encourages you to align your investments with your own values, interests, and goals. If you're passionate about technology, focus on tech companies. If you understand retail, invest in retailers. The key is to play to your strengths. By investing in industries and businesses you understand, you gain an edge over the average investor. A timeless guide. At its heart, Common Stocks and Uncommon Profits isn't just a guide to investing, it's a philosophy for approaching life with curiosity, discipline, and a long-term perspective. Fisher challenges you to think deeply, act decisively, and remain patient in the face of uncertainty. As you close the book, you're left with more than just investment advice. You have a new way of thinking about business, risk, and opportunity. And with Fisher's principles as your compass, you feel ready to navigate the markets with confidence and purpose.